Hey, what's up, traders and investors? Ben at TyndallTradingAnalysis.com. It's Tuesday afternoon, August 23rd, 2022. Stocks turned sharply lower last Friday following 4 consecutive weeks worth of positive returns, which hopefully came as no surprise if you've been following my work. Just last week, I emailed you to let you know the indexes were rapidly approaching overhead resistance that I did expect would result in a sell-off. Now, this is, as they say, where the real work begins. You see, while the indexes have made significant progress from the June area lows, we still don't have evidence of a trend establishing development, meaning there's still the possibility we've been in a corrective or, quote, bear market rally, and the indexes are going to break down and set a new low for the year. That is why we expect the next 2 to 4 weeks to be the most critical of all of 22, where markets have the opportunity to either confirm upside resumption or, alternatively, fall victim to the 2022 downtrend. So sit back, relax, take you full screen on the charts, and I'll show you what we need to see in the markets next. And before we get started, let's take a quick look at the chart of the S&P 500, which I included in last week's public market email, bringing your attention to the expected turn lower in the markets. Here I noted a confluence of overhead technical resistance in the S&P 500 in the form of the 200-day moving average, downtrend line resistance from the all-time high through the late March high, and of course the late April, early May swing wave high near 4308. Now that is the zone that I expected would reject and result in a pullback towards 4100 in the S&P, which, fast forwarding to today's price action, looking at the hard right edge of the trading analysis edition of the Motive Wave platform, we see the S&P 500 has begun its journey further south. And this is where the markets have the opportunity to confirm the June 17th low as the end of the correction, or alternatively fall victim to the 22 downtrend and break south back towards 36. Now, before I show you where I expect markets to go from here, I need to give you a bit of a lesson on the Elliott wave principle. Now, I'll keep this simple. In the world of Elliott wave, there are essentially 2 classifications of overall price developments. We have corrective waves and we have motive waves. Motive waves essentially start trends. Those motive waves start either larger motive trends or they start larger corrective trends. And let me show you why that's important. If we take a look at this chart of the S&P going back to the all-time high in January of this year, we see an initial 3-wave sell-off finding support on February 24th. From there, the S&P delivers evidence of a 5-wave trend establishing, quote, motive wave, and that is then confirmed with a corresponding 3-wave pullback. What that means is from the February 24th low, we had a move up that could be A or it could be wave 1. Then we had a pullback that could be 2 or wave B. So what this up-down development told us to expect was at least an additional rally in a C wave position. Conservatively, that would have been the wave count at the time. The more optimistic bullish wave count at the time would have called this wave 1, would have called this wave 2, and this would have been wave 3, which would have only been confirmed if the S&P made a wave 4 that finished above 4416 and then rallied to make a new high in the wave 5 position. But that's not what happened. What actually happened is the S&P 500 moved down in another 5 waves. It violated the high from March 3rd at 4416, and what that did was simultaneously dismiss upside resumption and confirm downside continuation. And you might be thinking, how on earth could that level invalidate the uptrend? Well, thanks to the Elliott wave principle, the pattern developments come with clear, unbreakable rules and guidelines. And one of the key rules within a motive or trend establishing 5-wave development, that in the case of the motive impulse wave, you cannot have your wave 4 overlap the price territory of wave 1. That would be an invalidation of trend. Meaning, in a motive impulsive 5-wave trend, we need to see clear isolation and separation between our wave 4 and wave 2 positions. You can see coming from the high in March to the low on May 12th, 1, 2, 3, 4, 5, with clear isolation between the 4 and 2 correction. So again, up in 1 or A, down or 2 or B, we knew at least C, if not 3, was coming. From there, the S&P needed to confirm any sort of upside with a consolidation in 4 and then a new bid in 5. Why that is important is because we are up against the exact same setup now. In this particular wave count, I actually have it labeled as 1, 2, 3 instead of A, B, C. If this is 1, 2, 3, which based on the magnitude of the July 14th through August 16th rally, the magnitude alone would suggest that it is a third wave position, which is part of a new trend establishing 5-wave rally, but we don't know that that is the case until the market proves a wave 4 consolidation effort down towards 4050 to 4100. If this holds and we see a wave 4 that is more or less equal to magnitude and duration of this correction, and we then move to a new high, that will confirm and secure the June low as the end of the correction. So as I mentioned at the beginning, although we've made significant progress, we don't yet have evidence of a trend establishing rally. So the 44.16 level back here coming off of the late March high, which was violated, the minute it violated that move, it confirmed continuation. So that same level is now offered in our current pattern at 39.4586, meaning the S&P 500 needs to consolidate into support, hold. We expect this to complete sometime early September to mid-September. And then if this zone of support holds and we rally higher, then we'll do a larger correction, and then we should go for seasonal continuation. But again, we're not out of the woods just yet. This is a very volatile market. There's a lot to be considered still. There are still a lot of outstanding variables that could ignite another downside distribution move. And in the event we see the market break south of 39.4586, that will immediately confirm a move down to 36.36, or said otherwise, under 39.45, and you open up a near immediate 8% downside window. That target and range setup, you can see here, back coming off of the late March high, we have the same two levels. So this was either 1, 2, 3, as we had it labeled just a minute ago, and the target range, or the target on the move south under 44.16 was essentially 41.14. So here we are again. And this is why I should say we expect the next 2 to 4 weeks to be probably the most important development of all of 22. Now, in the event we do break that zone, we have it outlined and decomposed already here. This chart would suggest if the S&P moves sharply south of support and violates 39.45, as discussed, we're going to 36.36. Now, there is, as you can see here, about a 3.5% window between support and trend invalidation, meaning we should be able to determine, based on the velocity and magnitude of the pullback, whether or not this is going to end in a wave 4 into our wave 4 support zone, or if this is going to accelerate beyond it. Meaning, for those of you who are clients of tradinganalysis.com, we should be able to position accordingly, or I should be able to position accordingly and alert you to that effect well before we get to 39.45. But the conservative view would be to wait for 39.45 to break and target a move south of 36.36. But we remain more optimistic, and instead of invalidating the trend as we did back in April, we actually expect this to potentially confirm the trend. When we take into consideration the positive developments that we've seen across various growth sectors and industry groups, semiconductors as an example, in the semiconductor industry group, we already have a 5-wave rally from the low. Now, looking across the macro landscape, what potential catalyst could support either of these two scenarios? And we discussed this at the Elliott Wave Forecasting Hub webinar event, where I was a guest presenter last week, but I wanted to show you those charts here in the video update today. Looking to the chart of the dollar index, there is the possibility that in fact we completed a 5-wave move, meaning the dollar index is now going to consolidate sideways to lower. There is the possibility we completed a 5-wave move back middle of July, and we are now, technically this would be today, but there is the possibility, we'll get to that in a minute, there is the possibility that this is more or less a completed 5-wave move. And if this is a completed 5-wave move, then that would support the bullish scenario that you see here, which suggests we hold wave 4. Alternatively, if this cycle degree wave 5 is not complete, which if it is complete, it finished at the 78.6% retracement, more or less, of the decline from the 2001 high, and also the base trend channel from 2008 through 2011. That was also more or less a 1272 external retracement of the wave 4. So we had a confluence of technical resistance there in the dollar. But last week we saw the dollar index hold support and turn higher, which opens up the possibility that we still have further upside in the dollar. And if we still have further upside in the dollar, I would expect the indexes to likely continue further south. If we are going to continue higher in the dollar, there's two ways in which we can do so. This chart here is of the daily time frame, and we are looking at the green cycle degree fifth wave that I just showed you over here on the monthly time frame. So looking at the green cycle degree fifth wave, there are two ways in which we can keep the uptrend alive in the dollar index. The first way is the chart that you see here. And more recently, the 104.52 low came at a confluence of technical support offered from 2 degrees of trend, a fib projection from a wave 2 of the same degree, and a key retracement. Those levels include orange wave 4 and 2 equality. As we know, corrections of the same degree often tend towards equality. We also, within the orange wave 4, have equality of Y compared to W at 104.46. And then inside of blue Y, we have equality of C compared to A at 104.44. We also have a 78.6% retracement of the post-triangle breakout. All of those levels stacked right into the 104.52 to 104.62 zone, and that has since delivered a rally to the tune of nearly 5% in the dollar index. Now, if we don't go immediately higher in the dollar index, we still need to be aware of and be monitoring for potential sideways consolidation. If we take a look at the child waves of the orange cycle degree trend, we will find green B of intermediate 4 and orange B of green minor 4 both made new highs relative to wave 3. Meaning we made a new high in a triangle, we made a new high in a triangle, and if we're going to see this wave 4 respect what the child or subwaves have done in their wave 4 positions, perhaps we are just going to enter sideways consolidation. Now, if we start to break back south towards 104.51, then and only then can we consider the idea that this wave 5 is complete, and then and only then would we have a higher degree of confidence in the bullish wave count. Now, don't get us wrong. We continue to remain bullish, but this is where the market needs to prove that that is the case, and this is where we can secure the June area lows. So I hope you enjoyed the market update. If you want to check us out, you can visit us anytime at tradinganalysis.com. If you are not signed up for our public email list, I promise you are missing out. It doesn't cost you anything. I know you will find value in what we have to offer. This was the chart from last week. You can go to tradinganalysis.com, wait for the pop-up, or simply move towards the bottom of the page, enter your name and email address to get signed up today. We typically send out between 2 to 4 emails per week, which include charts, videos, market commentary, webinar invitations, and of course the occasional promotional offer. Thank you all for tuning in. We'll be back tomorrow morning, 8:45 Eastern, right here on the Trading Analysis YouTube channel for our weekly public live stream show where we're going to talk more about the markets. Before we let you get out of here, let me take you down to the intraday time frame here. Looking at the intraday time frame, this is really a rather remarkable sequence. Here in the case of the S&P 500, what we're looking at here is a 1-hour chart going back to the June lows where we have that green 1, 2, 3 development. Now, this move looked like it may have ended on Thursday, August 11th, but we knew, thanks to Elliott wave on a 10-minute time frame, that this subdivision, being only 3 waves, does not satisfy the requirements to complete the higher degree wave 5 of green wave minor 3, which means that was not the opportunity to get risk off and trade the index short. What ended up happening is after meeting resistance Thursday, we pulled back and proceeded higher as we had forecast with our clients. What we did, thanks to the clarity of the ending diagonal development in the NASDAQ and the S&P, we opted to short the S&P 500 right back there on August 16th, about an hour before the index actually topped. And as you can see, we have since moved sharply south. So this is the zone. This is the make or break zone. This is the range We're not quite sure what this fourth wave pattern will be, or if it will even prove to be an overall fourth wave move. As I just showed you, there's still the possibility this has been a large corrective rally, which is why the next 2 to 4 weeks are so very important for financial markets. Appreciate you all. Have a great evening. Have a great afternoon, possibly great morning, depending on where you're tuning in from. And I will see you all back for the next public update. Take care.